So what happens is that biggest challenge for an Indian saver, how does he preserve? First is preserving the capital and then making some money on top of it. Because if you make 8% post-tax, you'll barely preserve. And we have only long series of SBI 3 years rolling fixed deposit rates. That is about 8.5% for last 34 years. So basically, if you had deposited all the money in 1979 in the fixed deposits, in that case, it would have been about the same price. 100 would have remained 104 inflation, adjusted for the inflation. If you are lucky to buy some gold, it would have doubled. But if you had bought stocks without dividend, ex-dividend, it would be about more like 15, 16 times. If you include the dividend, it would be more like 25, 30 times. So the one place where you can comfortably make money, comfortably I am saying, not with much of stress. If you go and buy just the ETF, just the Sensex or Nifty ETF, where cost is very low and you are not taking any manager risk, still you will make 15, 17%. Definitely better than a fixed income instrument. So making money, making about 14, 15% in the market is far more simpler than what it is made out to be. But making 20, 25% is far more difficult than one thinks it is. So CNBC and all, they try to make it very easy for you to multiply money day after day, but you know how many people they multiply their money. So, making money at a faster pace of upwards of 20% is very, very difficult, seriously difficult. So, if people want to come to the markets and they decide to get in, but typically what is the mistake they commit? They come into the market like this. A lot of people, they have invested in fixed income, they have invested in real estate. So hundreds of crores are stuck in different kind of assets which are not liquid, maybe which is not yielding properly, and they want to get into the stock market. So typically what they will do, if you have 100 crores or say 1 crore, you will put 2-3% into the market and try to test the water whether it works or not. If it works, then you start putting a little more, then a little more, then a little more. And right at the end, right at the top, you'll become so confident that you'll put your balance 50%. So on an average, you bought it at about, say you started, say 20,000, you start going till 40,000, and at 40,000 you put the maximum amount. So average you have bought at 30,000. So whenever market crashes, you are stuck with the losses. And then next round, you'll never do it because you have a bad experience. The way to go about investing is like this. You have to invest whenever you are confident. Please go whole hog. Markets are not going to wait for your confirmation of how to go about the investing. I mean, if you keep taking 4, 5, 6, because see, typical cycle is about say 5, 6 years of bull run and 3, 4 years of bear run. I mean, that's been the trend of the market. I've been seeing it for last 30 years. 85 we had the first bull run, 92 we had the second one, 2000 we had third one, 2007 we had the fourth one. We are overdue for a bull run. Now, why it will come, how big it will be, I don't know. But it is in the making. Now, we had a very prolonged 4-5 years of bear market. So, if you start investing now, and even now, if you say that let me try for 2 years, if it works, then I'll put some more. Then what happens is by the time you come to the market, you are too late. So, it is very important, if you're convinced, go in with a lot of confidence in the market. And I would expect, if you want to put 10 crores, do it 9.5 crores tomorrow morning. And another 50 lakhs you can keep timing the market. That's the way to go about it. It's like taking a dip in Ganges. If you go to Haridwar, water is cold whatever time you go. You go in the morning, it's very cold. Go in the afternoon, it is as cold. You go in the evening, it is very cold. So you're not going to get relief. I mean, it's going to be uncomfortable. Whenever you take a dip in Ganges, it is going to be cold. So it's like that. When you buy into the stock market, and if you don't understand, if you're basically not that comfortable with the market, for me, it's always very warm, like 30-degree water. So I take always a plunge. I mean, I'm fearless. And I'm quite sure here I can see some faces who are more fearless than me. So it's not that nobody knows the market. but you have to be very comfortable with the market. Don't do anything in life which is not comfortable. And swimming is not one of the most comfortable thing. So stock market is, that kind of thing. And you gain experience slowly. But have faith in the future of the country. Have faith in your entrepreneurs. What you're buying is the businesses. You are clearly buying set up businesses. And what happens to the businesses? More than what happens to the country. A lot of people are concerned that country's future and business future is aligned. No. Businessmen will always find ways of making money irrespective of what happens in the country. I mean, if country goes or currency goes completely bust, obviously the companies cannot do much. But I mean, Infosys has not become 6,000 times because country has also gone 6,000 times. Or Hindustan Lever has not become 10 times in last 10 years because country has gone 10 times. So, or very recently, iShares has not become 30, 40 times because the country has gone or automotive industry has grown 30, 40 times. So clearly, there is a disconnect between what happens in the country, what happens in the broader economy, what happens in the international economy, and in a specific company or businesses. You are going to make only as much money as much the company is going to make. You are not going to make any more. If a company makes losses and you buy the stocks very cheap, you are not going to go very far. You will have to sell that stock at loss eventually. So be very clear, you are going to make only as much money as the company is going to make. So if you want to make money seriously in the market, you have to buy the stocks, and no company can make money tomorrow or day after. You have to give long enough time. So you have to buy good companies, let the companies make money, and you will make money. But when you are going to invest, please invest with confidence. Rather than, with a lot of fear you get in, and if anything happens, because it is quite guaranteed, the moment you will buy, market will go down. Are you ready for that? One of the things is that people say that market should go up or down. I mean, I think market should fall by 30% tomorrow. If market falls by 30%, we are done. Fantastic. आपका जितना पैसा आएगा सब 30% नीचे में अंदर जाएगा. So I am wishing the companies which I am buying, they should be a little cheaper to me, because I am a continuous buyer. I am continuously buying. Still we are going to see a lot. See, money started coming only 12 months back. So the lot more money is yet to come. And hence it is important that market remains here. I mean, market should just not move till your money is in. People want to buy, if they want to buy 100 shares, the moment 10 shares are bought, they want the market to go up. They love to buy little higher price 20 shares and even higher price 50 shares. So, that's a wrong attitude. Buffets and all, they don't inform anybody. They will buy everything even before people come to know. And they would like to buy a huge lot so that there is no impact on the price. Because your purchase price will determine your ultimate return. If you buy a thing which is going to be, say, worth 1,000, if you buy it 100, it is 10 times. If you buy it 200, it will be only 5 times. So your purchase price is very important. So what we must wish is a lower market tomorrow if you are buying. If you are selling, obviously you must be wishing a little higher market. So don't be too much worried about the market. It is not about when you bought it. It is what you bought it and how long you stayed in the market. If you buy wrong thing, even in a dull market, you will not make money. But if you buy a right thing, even in slightly elevated market, you will make a lot of money. So this guy, wealth manager from America, he says, I'm not afraid of being the next 25% downtick. I'm afraid of missing the next 100% uptick. One cannot time the market. See, this timing the market is the biggest curse. And we have six channels. They are trying to help you time the market by the hour, by the half an hour, 10 minutes. Opening trade, closing trade, midday trade. Pagal kar dega aap log. The point is, money is not made by the hour. No company can make money. I mean, even Aisha, who is making a lot of money, or Reliance, which is making a lot of money, they cannot make money by the hour. But you want to make money by the hour. Nahi hone wala aisa. Only brokers are going to make money by the hours. So you have to be very clear. If you want to make serious money, you have to be very peaceful. You must buy with lot of thought and buy for long period. 3 years, 5 years, 10 years, then the company's values will change. And that's how your portfolio will go up. So the great long-term risk of stocks is not owning them. I'll tell you why I'm saying so. Look at it. The stock market is up 100 times in last 30 years. And I have lived this entire 100 times. I bought my first stock in 1980. And there are a lot of people who must have been in the market even earlier than me. So they have seen market going more than 270 times or 280 times. Because in 1979, index was 100 and the guys who were there for 75 or 72, they must have started at 50 index, notionally. So markets have moved. It is the ultimate bull market in the world. Where come X dividend is 100 times in last 30 years, come dividend 100 times in only 25 years. And this is the index. If you had one lucky strike in 5% in Infosys, 2% in Infosys, something other, you would have just made tons of money. And that's the experience of most of the investing type of people in the market. And we have lots of them. And particularly in Mumbai, all the Parsi community and a whole lot of old guys, they made so much of money in one stock here, one stock there. So the stocks have that power. Yeah. So what happens is when you want to buy stocks, what do you want to buy? Do you want to buy low quality or do you want to buy high quality? Of course, everybody wants to buy high quality, but they are expensive. So what happens is everybody knows the price of everything, but very few know value of everything. There is a difference between value and price. Value is what you get, price is what you pay. When you pay 10 rupees, you get a bottle of water. So the seller, for him, he is emotionless. He is giving you a bottle of water. But if you are very thirsty, you are dying for a gulp of water, for you the value is not 10 rupees. It is 1,000 rupees, 2,000 rupees, a lakh rupees. So value is different, distinctly different from the price. And people equate the value is equal to price. No. That's why the opportunity is in the market. Because in the market, there are 5,000 companies and there are millions of investors. And there are very few guys who know the value, but price is there for everybody. And everybody wants to judge the price by only looking at the number. You can never do it. Quality companies are very difficult to figure out what should be the price. Look at in any aspect of the trade. If you look at the diamonds, look at the IF quality or the best quality diamonds. See, when the quality and size starts increasing, the price starts going disproportionately up. For a 1 carat diamond, if something is $1,000, a 10 carat diamond with a better quality will not be 10 times more. Might be 100 times, maybe 1,000 times. Same thing happens here. There is only one Nestle. There is only one Hindustan Lever. So all these unique companies, they will make limited amount of money, but they will keep making money for 50 years, 100 years. And that's the basic difference. What is the longevity of the growth and longevity of the money to be made by the companies? And markets are the ultimate discounting machine. Market is one place where you get value for what is going to happen in the perpetuity today. I mean, when you say TCS is 5 lakh crores, what you are saying? You are saying that TCS, present value of all the money to be made by TCS is 5 lakh crores. Now, that's what market is saying. But if you think that present value of all the money to be made by TCS is 25 lakh crores, you should go and buy. But it is function of your understanding of TCS, how good it is. And that's why you find few stocks where the manager has understanding of those values. By buying 70, 80, 100 stocks, just by buying them, I don't think you bring any advantage to the investor. It is very important to buy what you understand, whose value you understand. So in quality companies, values are too much. And in a low quality companies, values are negative. They are liabilities they are curse for the market. Those companies must not exist, but they're there. What do you do? And that's the biggest problem between stock market and gold market. In gold, you go any shop, you get that biscuit, 100 rupees here and there, you get even quality. But in the market, there are a lot of quality. quality problems. Something is 10 carat, something is 5 carat, something is minus 5 carat, and the lower the carat, shine is more. They are much more in the CNBC than the companies which are very good. Very good companies actually don't meet only, they don't meet us also. And yet you have to buy. So, you have to understand the quality. Quality is disproportionately better than low quality. And there are a lot of low quality stuff in this marketplace. And you have to pay to the manager. If you are not good in understanding difference between good quality and bad quality, please don't manage your money. Find a guy who can understand difference between good quality and bad quality. But if you want to invest for investing has to be for long term. You can do speculation in any stock. It doesn't matter, low quality, bad. Because stock speculation is nothing to do with the fundamental. It is only the movement of price. Who's bigger full theory, But in investing, you can't fool around with anything. In 10 years, you're not looking for bigger fool. You're looking for a company which has made 10 times more money. If the earnings grow by 10 times in 10 years, either you'll make 9 times or you'll make 11, 12 times. Nobody can stop you from making money. You are making money because the company is making money. You're not making money because you are the smart guy. The stock doesn't know that you own it. And just because you have come to the stock market, there is no guarantee that you will make money. It is not market's responsibility to make money for you. You have to make money in the market. It is like saying that I'm a chartered accountant, so I must make a lot of money. No. That chartered accountant has to work to make money. It is in any profession. Just because you are a doctor, you are IIT Ahmedabad, there is no guarantee the system will give you money. You go to a job, first day you'll go to a job, they'll give you 25 lakhs offer, and if you don't perform, they'll throw you out. So, there is a lot of work to be done to make money in the market. So, we try to position the portfolio high quality, reasonably priced. Because high quality cheap, you must buy as much as you can. But there are very rare opportunities that high quality companies are available at reasonable prices. So you have to buy maybe a little expensive, but as a whole, as a portfolio as a whole, you must be able to position the portfolio at a center of the price. I mean, in the sense that we don't buy very cheap, we don't buy very expensive. So this year's wealth creation study about, as I told you, this is the summary of the book, vision, courage and patience. That's what you need. And 100x doesn't mean that anybody can see that this company is going to become 100. A lot of people, they ask me, what is the next 100x? Nobody has any clue. You should not play for 5, 10, 15%. You must play for the big game. That yes, it will be 5 times, 10 times, 20 times, 100 times. Because future unfolds. Good thing is that future unfolds day after day, day after day. Nobody knows. Even the entrepreneur doesn't know he's going to become so big. I mean, I have lived the entrepreneur's life. There are a lot of people who have lived the entrepreneur's life. You start zero. Then you meet with some success. Then even bigger success. Then bigger success. So, I mean, it's like politician. He wins first the corporator. Then he becomes a MLA. Then he becomes a minister. Then he becomes chief minister. Now you can be a prime minister also. So, that's how the businesses become. You start with 100 crores. I mean, your HDFC Bank is started with 200 crores into 4. So, 800 crores the total market cap. You could buy entire bank for 800 crores. What is the market cap today? 2,50,000 crores. And it's still counting, growing at 25% still now. So, future happens one by one. Once you buy the right, just sit tight. So, as I said, market itself is 100 times in last 30 years. So, these are the stocks which did 100 times, more than 100 times, and stayed as 100 times more on 31st March 2014. Infosys 3,000 times from 94. If you do it from 93 day of listing, it is 6,000 times. Lupin, Wipro, Motherson Sumi, all these companies are again double in last 12 to 18 months. They have beaten hollow as a group, all the indices. So clearly, and this covers almost all the stories of last 20 years. Smallest is Asian Paints, 106 times, 27%. So you see all these stories, and so it's not only about Infosys or Lupin or something. you will see so many companies that I have been blessed with investing in, say, Hero Motocorp, somebody is blessed in Titan, somebody is blessed in HDFC Bank, and there are people who have committed mistake also. Like I have committed mistake in getting out from HDFC Bank. I bought it with so much of passion at 40 rupees and at 52 rupees. Some analysts said that there is going to break down, so I got out. So I lost everything. I mean, 6 lakh shares gone at 52 and a half. We never saw the price. So there are a lot of mistakes. That's where the patience comes. When you have the conviction, sit on. You know. So it is very important to buy right and spend a lot of time with the stocks. So what are the characteristics of these companies? How do you buy a big winner? 100x, 1000x, 2000x? Because times are becoming exponential. These are exponential times for India. And these are the rare opportunities. I mean, internet is making even super exponential. But clearly, these are the exponential times for India. Very rarely a country achieves $1 trillion in 60 years. Then the next $1 trillion comes in 7 years. The third will come in 5 years. Fourth will come in 3 years. Sixth or seventh will come in 1 year. What you did in 60 years, the country will achieve in 1 year. So you're in an exponential phase. What happens is in this phase of next 15, 20 years, your fixed expenditure, your non-discretionary spend will remain where it was, say $1,000 per capita. But when you go from $1,000 to $2,000, your discretionary spend will go from from 100 to 1,000. So what is the doubling of GDP will be 10 times for discretionary spend. It will be very exponential. And as you go from 2 trillion to 4 trillion or 8 trillion, you see the demand for all luxury cars, your spend in the marriages, and even spend in the infrastructure. Everything will just keep accelerating. So this is the time we are living. You have to find the right category of the businesses which are going to explode, and in that, the right company which is going to explode. So category winners and winning categories and category winners. That's what we need to position the portfolio for. So what should be the characteristics? The company should be relatively small. Now, if you buy up to about 2,500 to 3,000 crores, now because of the size of the market, you're fine. 80% of the market qualifies fundamentally to be, it could be a multi-bagger. So, you don't have to buy 300, 400 crores company. But now you can buy up to 2,000, 3,000 crores company because now the largest company is 5 lakh crores. 10 years, 15 years henceforth, when you will, your stock will mature, by that time the largest company would be about 50, 60 lakh crores single company, minimum. So, you can go from 2,000, 3,000 crores to 3 lakh crores, 5 lakh crores without any problem. You need to be that visionary to see the future of these kind of companies. The business has to fundamentally very high quality business. If business is bad, whatever is the quality of management, it is not going to help you. So you have to buy top class business. Now, businesses are 3 types: great, good, gruesome. So if you are able to buy good business or great business, it's fine. But there are a lot of useless businesses. As I said, 80-90% of the companies are in very bad businesses. Seriously bad businesses. You have to avoid those companies entering your portfolio. They enter the portfolio because of their cheapness. Cheap companies are really very expensive in the market. Very seriously expensive. And people end up buying and they forget when they bought it. And if, say, you bought something at 5p at 100 rupees and after 10 years sell at 200 rupees, you think you have made money. No, you're not made money, you destroyed money. So clearly you have to avoid bad businesses. Now what are the good businesses? Businesses with high return of equity, high return on equities, and they typically come from large profit pool. Like say banks. Banks make money all over the world. Nothing new in India. But in India, you have some banks, 5, 7, 8 banks, which are private sector, and you have large plethora of public sector banks. So in large economies, 70% of the banking system is sick. So, but then economy is still running. So disproportionate profit is going to the well-run private sector banks. So when you get a good bank coming into that segment, which will come, some more HDFCs will come into being in the years to come. You'll get opportunity to buy at 1,000, 2,000, 5,000 crores, new banks. Next is value migration. You know what is happening is the world over, the businesses, the value of the businesses are not at one place. So typically what happens is the profits move from one business model to the better business model. So if you have a wireline telephone, it will move to wireless companies. See, the earlier profits were in BSNL and MTNL. Today, they are bankrupt today. They are making losses. Who is making money? All the wireless companies. Now, what are we seeing? Reliance coming with Reliance Jio. That's an IP base. That's the next generation of telecom companies. So profits will move from wire to wireless to IP based. So profits keep moving like that. So like earlier it was a scooter market, from scooter to motorcycle. Again from motorcycle to again probably some amount of scooterization is happening. Public sector banks were making all the money. Now private sector banks are making money. So profits keep moving. Pharma companies, all the European pharma companies, they were making money. Now some amount of money is being made by generics pharma company like your Lupin, your Sun Pharma, all these guys are making money. So there is a lot of money. When the businesses move from developed market to developing market, because the cost structure here is very low, you make a lot of money.